Hello, and thank you for tuning in to Berkadia's second half of 2022 economic forecast. We're fortunate and excited to be joined by Aneta Markowska, Chief Financial Economist at Jefferies Financial Group. Aneta is going to play the part of a jungle guide to help explain the current economic landscape and its anticipated impact on commercial real estate in the latter half of this year. Most of you know that Jefferies is our sister company, and it's a pleasure for us to find more ways to work together. Before Aneta offers her perspective, I thought I'd touch on a few of the themes we've observed relating to the multifamily sector during the first half of 2022. It's a very complex and dynamic marketplace, so the half-life of my comments is probably as long as it takes you to turn on MSNBC. However, while things have changed, many things remain the same. First, while we saw transaction volume to be challenged across many of the commercial property sectors in the second quarter, driven by surging inflation and interest rates, conversely, multifamily investment activity hit a new record high, reaching $86.3 billion in total volume, up 42% year over year. Transaction was up more sharply in secondary and tertiary markets, but of the top 25 markets for multifamily investment, all but 5 markets surpassed the prior high water mark for activity through the first half of a year. Dallas-Fort Worth, Phoenix, Houston, and Atlanta led the way. Some few of us can remember the concern at the start of the pandemic surrounding this long-term outlook of multifamily rents. As Warren Buffett's been known to say, every decade or so, dark clouds will fill the economic skies, and then they will briefly rain gold. At the national level, rents have more than recovered from the drop during the onset of the pandemic to reach all-time highs in the second quarter of 2022. Monthly effective rent averaged $1,736, up 14.8% year over year. In addition, average occupancy also climbed. Occupancy averaged 96.8% in the second quarter of 2022, up 60 basis points year over year. Lastly, under a quarter, or 88,000, of the more than 382,000 units scheduled to come online this year came online this past quarter. Annual net absorption in 2021 totaled 431,300 units, the strongest levels in recorded history. However, net absorption atypically shifted negative in the second quarter of 2022 as 55,800 more units were vacated than occupied. A possible explanation for negative absorption is that renters aren't finding apartments they want at their price point. Backing up this explanation was the sharpest drop in occupancy quarter over quarter among Class A and Class B product. Class C occupancy continued to remain significantly higher than all other apartment product in the second quarter. This could just be a blip, or it might be the canary in the coal mine indicating a start in slowdown in household formation as individuals bundle households. A positive indicator for apartment demand in the near term is rising rates are manifesting in softening demand for new single-family residential mortgages. Many individuals are choosing renting over home ownership. In summary, apartment fundamentals remain strong in the first half of 2022, and capital continues to flow into the multifamily sector unabated due to strong economic and demographic trends. While the private investor continues to dominate multifamily transaction activity, we do expect to see more institutional investors playing a larger role in investment activity during the second half of 2022. These are just a few of the themes we've observed and will continue to monitor throughout the second half of the year. Before I turn it over to Aneta, I just want to reinforce that we are working in a very complex marketplace. So success will be more likely had by those who are vigilant, discerning, and disciplined. I can't stress enough how important it is to have a trusted investment sales advisor and mortgage banker by your side to help you identify the best capital solutions to transact in today's marketplace. Fortunately, we have a great number of those here at Berkadia. I'll now turn it over to Aneta at Jefferies for an economic forecast. Take it away.
Hi, everyone. Thanks for joining me. And let me just jump right to it and start with the big question of the day and of the month, which is, are we already in a recession? And if not, what is the most likely time frame? So let's start with a look at the economy and at GDP in particular. We just received second quarter GDP numbers, and they did confirm that the economy, in fact, contracted in the second quarter. This makes it a second consecutive contraction, which is basically the textbook definition of a recession. So why is this still a debate? It's still a debate because the official, the practical definition of recession or the way that the official arbiter of U.S. recessions, the National Bureau of Economic Research, when they decide business cycle turning points, they actually don't look at GDP data. They ask four very practical questions. Is employment contracting? Are real incomes and real sales contracting? And is industrial production contracting? And right now, none of those things are true. So what actually caused the contraction in not just the second quarter GDP, but in the first half? The simplest answer is inflation, right? So typically recessions are caused when there are excesses in the economy, people sort of run out of purchasing power, and nominal spending slows, and that ultimately causes profit losses and layoffs, right? None of those things are present at the moment. In fact, when you look at nominal GDP or nominal spending, it continues to be very strong. It averaged around 7% in the first half of the year. It actually accelerated in the second quarter, as you can see on this top chart here. The problem was inflation, right? Inflation was so strong in the first half of the year, and particularly in the second quarter, that it essentially eroded all of those nominal income gains. And you can see on the bottom that indeed inflation was north of 8% on a quarter-on-quarter basis in the second quarter. So that was the real problem. The reason that's important is because there is no evidence that consumers are slowing their spending, that businesses or even local and state and governments are slowing their spending. And to the extent that inflation actually starts to recede in the third quarter, we think that the economy is poised to actually accelerate in real terms. But really, again, it goes back to, when we look back at this period a few years from now, we might say, hey, do you remember that recession when no one lost a job? When people continued to spend money, when earnings went up, and when the Fed didn't cut rates. That is sort of the environment that we're in today. The big question, though, is, will this contraction in real output in the first half of the year ultimately trigger a layoff cycle? Because that's the mechanism through which this could actually turn into a full-blown recession. And when we look at real-time data on the labor market, we really see no evidence that companies are reacting in that way. We have seen a little bit of a pickup in initial jobless claims. So yes, some companies are laying people off, but continuing claims or the total number of people claiming benefits basically continues to sort of bounce around the lows for the cycle, as you can see in the top chart here. And what that's telling us is that, again, those people that maybe work for companies that are experiencing some stress, to the extent those workers are being laid off, they're finding jobs very easily in other sectors. So they might be collecting benefits for a week or two, and then they're falling out because they're hired quickly somewhere else. And then when we look at real-time data on job openings, right, that's a better gauge of labor demand. Again, we see no real evidence of weakening. Job openings have stabilized at a very high level, but there's no evidence that they are rolling over. So why is this the case, right? Why are companies not reacting to a decline in real output in the way that they typically would? And I think this really goes back to why companies lay people off, and why do we have recessions in the first place? To me, recessions are really nothing more than periods of corporate restructuring, right? Strong companies don't lay off workers, weak companies do. And so profit margins are a very good indicator of where we are in the business cycle or in the profit cycle. And as you could see from this chart, typically recessions come after extensive periods of margin deterioration, right? It's when the corporate America as a whole has been burning cash, has seen its margins and balance sheets deteriorate. At some point, companies realize that, maybe their downgrade risk goes up, their default risk goes up, and that's when they switch from an expansion mode to a self-preservation or cost-cutting mode. When you look at where margins are today, we just don't seem to be anywhere near that stage of the business cycle. So yes, we just experienced a significant shock, right, an inflation shock. But the fact that this has happened at a time when corporate America is very, very healthy, I think reduces the odds that this actually snowballs into a proper recession with a significant layoff cycle. When you look at balance sheets as well, whether it's for households or businesses, we really see no indication of an economy that's about to enter a recession. there's still a lot of firepower in terms of excess cash, both on household and business balance sheets. You can see here that households are still sitting on $3 trillion of excess cash. And that is in part why they continue to spend so aggressively, not quite enough to offset inflation, but nonetheless, very aggressively in the first half of the year. And debt service ratios are quite low as well. So for those who worry about interest rates having risen, I think that's a headwind certainly for the housing market, but it doesn't seem to be headwind for consumption or business spending just yet. And when you look at corporate balance sheets on the bottom chart here, a very similar story, right? A lot of excess cash, about $500 billion. That's worth about 15 to 20% of annual capex spend. So companies certainly have the means to invest, and it's sort of very hard to envision, again, a full-blown cycle of layoffs in this context. So our base case is that, we need to see further margin deterioration in order to put an economy kind of on the cusp of a recession. And we think that process will start this year in the second half, and then it will intensify early next year, and ultimately create a recessionary dynamic in the second half of next year. So our base case is that the next recession will start around the third quarter of next year, about 12 months from now. In the near term, though, as I alluded to earlier, I actually think that we are poised to see growth pick up a little bit as inflation recedes. So here's where we are in terms of inflation, viewed through the CPI, one of many, but probably the most important recession indicator. You can see that the CPI accelerated to 9.1% on a year-over-year basis. Core also running very, very hot. But, and there are a lot of forces driving this, but one of them certainly is the spike that we saw in commodity prices following Russia's invasion of Ukraine. So that's the bad news. The good news is that when you look at commodity prices and what they've done so far in July and what they're projected to do based on the futures market, here, for example, you're looking at energy futures, they are suggesting some downside for those energy components of the CPI, which are quite important. Just to kind of put it into maybe terms that are more intuitive to understand, gasoline got to as high as $5 a gallon in the middle of June. It has since declined to below $4.30 a gallon. This is a national-wide average. So it's down about 15% from the peaks. And to the extent that that spike in gasoline prices created a lot of stress on consumer finances, and in some cases even caused increases in subprime delinquencies, we think that stress is sort of on the verge of partially reversing. Even in terms of agricultural commodities, it takes a little bit longer for food or for those commodity prices to feed through to food inflation. But nonetheless, those commodity prices have started to decline. And suggest that at some point, maybe around the turn of the year, we should start to see food inflation subside as well. And so again, that slowdown in inflation that appears to be in a pipeline, we think will provide some relief and essentially help extend the cycle. There's also been an improvement in the supply chain. That's another reason to anticipate some easing of inflationary pressures. When we look at imports absolutely exploded on the upside, in the fourth quarter, and that really accelerated into the first quarter. You could see here that imports were lagging retail sales or U.S. consumer demand for the better part of last year, creating a huge supply-demand imbalance, which caused inventories to be drawn down. You could see on these two charts on the right that has been in the process of reversing. We've actually seen a significant buildup of retail inventories, and retail inventory to sales ratios have also started to bounce. And so that also suggests that for consumer products, at least not services, but products, we should start to see those inflationary pressures abate over the next several months and quarters. This doesn't mean that inflation is no longer a problem and that's going to go away. There's still a problem in service inflation, which is basically emanating from two sources, housing or rental inflation and the labor market. But that's a problem that I think will sort of resurface or reassert itself maybe around the turn of the year. So when I think about, the 9% inflation that we're experiencing right now, or that we did as of June, I think that, the first 3 percentage points we can shave off the top fairly easily by just, kind of achieving a stability in energy and commodity prices, right? That gets you down to 6%, say, by the end of the year. Then I think we can shave another 1 to 2 percentage points with this improvement that we're seeing in a supply chain. And so it's going to look and feel for the next 6 months like inflation is, certainly moving in the right direction. I think we're going to run into another problem early next year when inflation gets down to 4% and then it plateaus. And I think the reason it's going to plateau is because those last 4 percentage points of inflation are actually coming from sources that are unlikely to abate. And one of them is the labor market. When you look at kind of the list rents and how much they've increased over the past 2 years, and where the CPI housing indices are today, there's still a significant gap. So yes, rental inflation has certainly slowed in terms of observed market rents. But there's still a lot of outstanding leases which have yet to reset to these new higher market rents. And that process of catch up will continue to lift the CPI, I would say at least for the next 12 months. So that's one area where we actually don't anticipate much improvement. And really, when you look at the labor market today, I think that is ultimately one source of inflationary pressures that will be much harder to eliminate. And that's why we think that, a recession is ultimately an inevitable cost of getting back to 2% inflation. We don't think the Fed can really fix the inflation problem without causing significant weakness in the labor market. So would absolutely agree with the idea that a recession is inevitable. We're just arguing that it's not imminent and that will probably take another 12 months to get there. Let's look at the labor market, because I think that's going to be a very important driver of interest rates going forward. And again, the timing of the next recession. It's very clear when you look at unit labor costs, and unit labor costs really capture total employee compensation, not just wages, but benefits, bonuses, etc. And then it sort of adjusts for efficiency gains. So it's really trying to capture the portion of labor costs that companies are not able to offset through productivity, and which therefore they have to try to pass through to consumers, and that essentially what causes inflation. And so unit labor costs right now are rising at a pretty significant pace, over 8%, telling us that indeed a big chunk of inflationary pressures are coming from the labor market. And again, to get inflation back to 2% sustainably, we need to somehow find a way to push unit labor costs down to 2%. And I think that's going to be very, very difficult without causing some weakness in the labor market. What's causing those pressures in the labor market right now is we're looking at a very significant imbalance between labor demand and labor supply. And one way to measure is by looking at the ratio of job openings to unemployed. That ratio right now stands at almost 2 times, and it's really, really rare. We've only experienced this once before in recent history, and that was in the 1960s. And of course, that was the beginning of, a kind of a very significant and prolonged inflation problem that took the Fed, the better part of 15 years to deal with. We do think that the Fed will react more aggressively. We've certainly already seen that from them. So certainly I'm not looking for the repeat of the 70s, but this nonetheless tells you that, this is a problem that will require very aggressive response from the Fed, and that again is not likely to go away on its own. This shortage of labor really is a product of a lot of different forces. I think fiscal policy certainly caused a massive shock to aggregate demand, right? Consumers had more money and therefore demanded more goods and services, and someone in turn has to produce them. And so you had a really large increase in demand for labor at a time where the U.S. population is aging. We essentially have very little growth in working age population. And at the same time, immigration that might have been an offset, or or even outsourcing might have been an offset. Those are really no longer a viable option for a number of reasons that I won't go into. So one of the ways that this shortage of labor is manifesting itself is by changing the relationship between wages and unemployment. So typically, when unemployment's at 4%, wage inflation tends to run at 3 to 4%. Right now, it's running at 5 to 5.5%. And so clearly labor is enjoying a lot more pricing power than it really has in decades. And if that relationship continues to hold for the next, 12 months, the idea of pushing wage inflation to 3.5%, it's going to be difficult to achieve again without creating significant weakness in the labor market. So typically to get inflation back down to 2%, we need to see wage inflation slow to about 3.5%. And that's because productivity tends to average about 1.5%. So 3.5% wage inflation is the ultimate goal if the Fed is in fact serious about returning to 2% inflation. And if we stay on the so-called steep Phillips curve, or put differently, if the relationship between wages and unemployment continues to hold as it has over the past 12 months, we really need to see unemployment go up towards 6 to 7% in order to get us on a more kind of normal inflation path. And that's why we think that the Fed will ultimately have to hike higher. And I'll get to that in a minute. But in the meantime, that strength in wage inflation, I think, is what's going to continue to support consumer spending. Not only are wages rising at the fastest pace in decades, but people at the low end of the income distribution in particular are enjoying very strong wage growth. You can see in these two charts that folks with kind of limited skills and low level of education are actually enjoying much more pricing power than people at the higher end of the education or skill spectrum. So this has certainly been supporting low income consumption, and I think will continue to be so, particularly if some of those price pressures, particularly in energy, start to fade. And just as, again, household balance sheets continue to be very healthy, right? So, we talked about strong nominal growth in the first half of the year. I think there is a good chance that we continue to see that in the second half of the year. One, because wages will support it, but two, because households still have a lot of firepower on their balance sheets. Here you can see what those cash cushions look like across the income distribution. Maybe at the lowest sort of end of the income distribution, people have spent some of that excess cash and the buffers aren't quite as big. But really for 80% of the US population, you're still looking at pretty significant cash cushions. And so when you combine that strength in the labor market, that strength in wages, and that cash sitting on household balance sheets, it's really difficult to become structurally negative on consumer spending and the economy. When you look at households' debt positions, no really red or even yellow flags there. Household debt to income is basically back to where it was before the pandemic, which was after a decade of deleveraging. So nothing really worrisome in terms of the liability side of the balance sheets. One of the questions that has come up quite a bit this year, given the sell-off that we've seen in equity markets and just financial assets generally, is what is that going to do to household balance sheets? And could that decline in stock market wealth ultimately dampen consumption? I think the answer probably is no, or if it's yes, the effect is likely to be very, very small, because the relationship between household wealth and spending has actually been quite weak over the past decade. You can see here that in the 90s and in the 2000s, households did tend to spend more when their net wealth went up. But I think after the experience of 2008, and obviously significant wealth losses there, I think households became much more conservative and have been much less likely to actually spend against those unrealized gains. Another reason this relationship has weakened is that the bulk of gains over the past decade have been in financial assets, and they tend to be very concentrated at the top end of the income distribution. So when you think about, a typical household sort of in the middle of the income distribution, for them, their house is their biggest asset. And home prices are actually still appreciating by about 15% per year. So that portion of household wealth is still increasing. So, the concern around stock market wealth is really only impacting about the top 20% of the US population. And those folks tend to have what we call low propensities to spend, right? They're much less likely to spend that incremental dollar of wealth that they earn or that might decline. So again, the sensitivities here seem very, very low. And I think that cash that's sitting on household balance sheets is a much more important driver of spending, and that still continues to be very supportive. I think, you can't really talk about the economy right now without mentioning housing. Of course, given the sharp run up in mortgage rates. Mortgage rates have essentially doubled this year from 3% to about 6% at the peak. They seem to be coming off at the moment, but still obviously very, very elevated relative to December. And so it seems that there's still a lot of weakness in the pipeline for housing. But this is a very different housing cycle than the one we experienced a decade ago. The only reason why housing demand is weakening is mortgage rates. It's not a weak labor market. It's not poor underwriting standards. And that means that the linkages between housing and the rest of the economy are likely to be much weaker as well. I talked about underwriting standards and sort of the household debt position still being very healthy. While we've had a mortgage credit cycle, the underwriting standards were incredibly healthy. So it really seems that no one will be in a position where they're forced to sell their home. In fact, I think supply of new housing will go down as rates go up because it makes it very unattractive for people to move and to walk away from those 3% mortgages. So while demand for housing is clearly declining, we think that the pricing environment will continue to be very firm, and that means that you're not going to have those spillover effects to consumption, related to the negative wealth effect. So our outlook for consumption for nominal spending is still very healthy. As you can see here, a lot of that upside is driven by continued employment and wage gains. And again, to the extent that inflation starts to abate a little bit in the second half of the year, we could actually see real GDP growth and real consumption accelerate. And I think that could be the surprise that very few people are talking about at the moment. There's, this recession narrative that's been very prevalent both in the financial markets, on Wall Street, as well as on Main Street. A lot of that conviction that we are in a recession is driven by sentiment data. So that's something we're being asked about, very frequently. And this chart shows you, and this is really true with respect to survey data in general, whether it's consumer sentiment or business sentiment, the relationship between, how people feel and what they actually do has actually weakened considerably over the past decade, as is pretty clear from this chart. So yes, sentiment is absolutely already in a recession, but I don't think that spending will necessarily follow for all the reasons that we've just talked about. In fact, again, if inflation does subside, and it was really that inflationary shock that pushed sentiment so sharply lower in recent months, and to the extent that that starts to reverse, we could actually see sentiment bounce a little bit. So I just expect things to generally feel quite a bit better over the next 3 months. We'll see if that continues into the winter. Obviously, Europe is facing some serious energy issues, once we get into the colder months of the year, and some of that could spill over into the US. But at least for the next 3 months, things are looking better. And I think that's why you're seeing improving sentiment, certainly in the financial markets in recent days. What does this all mean for rates, right, and for the Fed? The market right now is actually pricing cuts as early as the first quarter next year. I think that's quite a bit premature. I think a lot of folks are extrapolating from the survey data and sort of believe that we are in a recession. And I think there's also some extrapolation from the last cycle where the Fed hiked aggressively, but then they very quickly realized they made a mistake and they reversed course. I don't think the last cycle is a good template for where we are today, because obviously inflation just was a complete non-issue. And with, even if there is a slowdown in the labor market, I think the Fed will initially welcome it. In fact, Powell in the latest press conference following the last FOMC meeting said that a slower or softer labor market data is it's a necessary condition to actually achieve 2% inflation. So our expectation again is that we will not experience a recession for another 12 months. We expect it to begin in the third quarter of next year, but then we think that the Fed will actually wait a little bit, maybe as long as 2 quarters before they react, because again, they're going to want to see inflation really start to come down in a more meaningful way toward 2%, and that requires pushing unemployment, I think at least to 5%, if not higher. And so that's why we expect the Fed to continue to hike, not just this year, but into probably till around March of next year, and then just level off. And we don't expect cuts until 2024. If that is in fact the path for Fed policy, then obviously at some point the markets will have to reprice rates higher. We think they will, not necessarily in the next few months, but perhaps around the turn of the year. And we still expect the 10-year to get to about 3.5%, and maybe even overshoot that a little bit before the cycle really truly runs out of steam and before the economy goes into recession. So let me stop there, and I'm looking forward to the discussion.
Aneta, thank you so much for that fantastic update. We are definitely swimming in a pond with a lot of black swans, so getting an update from you is greatly appreciated. Now I'm excited to close out our program with a brief Q&A. Aneta, where do you believe the Fed's terminal rate will be, and how long will it be there?
So let me start with what the markets are priced for at the moment, and then sort of juxtapose it with my views. So the markets are currently, as of today, pricing a 3.25 terminal funds rate. And the idea is that we get there around the turn of the year, and the markets have cuts priced into the curve as early as the March meeting. I think that's incredibly premature. I actually think that the Fed will continue to keep hiking into at least the first quarter of next year. The Fed clearly is on a meeting by meeting sort of guidance, right? They're not offering any guidance. They're not going to tell us in advance what that terminal rate is. But I think the idea is that as long as inflation remains sticky and as long as the economy continues to hold up, they're just going to have to keep going. And I think that's going to be the case at least until March of next year. How do I get to, so my terminal rate is 4%, and how do I get there? I get there by, if I start with the premise that inflation is going to be sticky around 4%, right, for the reasons we talked about. A lot of it is coming from the labor market, and that's going to be very difficult to get rid of. And so that 4% inflation rate actually suggests that the funds rate should peak at 5.5%. Of course, the dollar is delivering some of that tightening. I think it's going to deliver about 100 basis points by my estimates, and then tighter financial conditions will deliver about another 50 bips. But that's how I get to a 4% terminal funds rate. And I don't think the Fed will reverse course as quickly, because even if we go into a recession, I think that the Fed will need to see a pretty significant increase in the unemployment rate before they can feel comfortable that inflation will decline. So I see us getting to that 4% terminal rate around the March meeting, and then staying there for the better part of next year, with cuts most likely coming in early 24.
Okay, so the second question is, Aneta, with the 10-year Treasury at 2.67% and the 2-year Treasury at 2.88%, we have an inverted yield curve here. How long do you feel that we're going to be inverted, and what does that mean?
So I expect the 10-year Treasury rate to peak around the turn of the year, right? Usually the 10-year peaks just before the Fed stops raising rates, and certainly before they start cutting rates. I think the curve will remain inverted for quite some time. typically the curve begins to uninvert when the Fed starts to cut rates. And typically that's day one of a recession. But this won't be like the last few recessions because of inflation. We think, again, that the Fed will have to wait a little bit longer. So, based on my timing of the first rate cut, the curve would uninvert in early 2024. So this could be quite a long inversion. And by the way, the curve just inverted within the last few weeks, and but the 10s Fed funds spread has not yet inverted. That will most likely invert, around the turn of the year. And the typical lead lag between an inversion and recession is somewhere around 10 months. So I think that's pretty consistent with the timeline that we've assumed. So again, I see the 10-year peaking close to 350, maybe a little bit higher. I think that's around the turn of the year. And then I think it'll sort of plateau. And by the fourth quarter of 2023, it'll probably be quite a bit lower, I would imagine, close to 3% or below that.
One more question, Aneta, and then we'll let you go because we greatly appreciate your time. So my last question, Aneta, has to deal with inflation. You mentioned by textbook definition that we are in a recession, but by the characteristics that you outlined that we definitely are not. If we are going to be in a recession, how will this recession be different than the others?
Yeah, so again, I think you have to start with the premise that this is going to be a recession that's a result of inflation and the Fed fighting inflation. So whereas, the last three recessions that we remember in our sort of, professional careers, those recessions were largely induced by outside shocks or by the economy just kind of rolling over, by excesses building up to the point where growth just couldn't be sustained. This is going to be, again, a recession almost deliberately caused by the Fed in an effort to reduce inflation, right? And so that makes it a very, very different downturn from the ones, again, that we've experienced over the last 2 to 3 decades. I think it's going to be much more reminiscent of the recessions we saw in the 70s and into the 80s. Not in terms of maybe the severity, but the longevity. Right. Whereas the last few recessions, maybe outside of the Great Recession, have tended to last about 2 quarters. And that's because, the Fed basically eased on day one, and the typical lags between policy and GDP are about 6 months. So, the Fed starts easing on day one, and 6 months later, you get an inflection economic activity. I envision this one, basically the Fed just sitting on its hands and watching the economy deteriorate, waiting for inflation to roll over, then starting to ease about 2 quarters into that recession. And that means that you're not going to get that positive inflection point until about 4 to 5 quarters after the start. So, it may not be as deep as the last 2, which certainly were caused by very, very significant exogenous shocks, but I think it will be much more protracted. And so we ultimately, I think, will still get to probably around 7% unemployment rate. I think that's where unemployment's likely to peak. At that level, the Fed will be comfortable that they can offer stimulus. And so it would sort of put it maybe in line with like the 90 and 2001 recession, somewhere between those two in terms of severity, but certainly not nearly as bad as the global financial crisis or the pandemic recession.
Thanks, Aneta. And now I'm going to turn it back to Justin Wheeler to close out.
Wow, that was fantastic. With that, we'll bring our discussion to an end. Thank you for listening in to Berkadia's second half of 2022 economic forecast. A special thanks again to Aneta for sharing her research and its anticipated implications. The team here at Berkadia has been pleasantly surprised by multifamily fundamentals in 2022. While the nation certainly has a ways to go in its economic recovery, with many health and policy change factors remaining up in the air, the outlook for multifamily is relatively optimistic. As always, please don't hesitate to reach out to any Berkadia professional with questions or follow-up. She or he will direct you to the right resource and get you the answers and insights you're seeking. Thanks again, and be safe.